Hey there everyone, happy holidays from the Blue Waters Group. We are here with CPA tax extraordinaire Sean Boyd of Boyd & Associates. And I know it's not tax season yet, Sean, but it's going to be here before we know it. And we have a number of clients, you know who you are, who bought a house in 06, 07, didn't sell their house in 07, 08, 09 because they couldn't. They turned it into a rental just to wait for the market to recover. Well, now the market has recovered, and I'm curious if those clients should be considering to sell their house now. And a couple of concerns that we have relate to taxes. So a couple tax questions for you.
Okay.
So again, using that scenario of someone who bought a house for $400,000, the value went down to $300,000. Actually, should we do a little visual?
It'll probably be easier on the board if we put it up.
Okay, let's do that. All right, and we're back. Voila, numbers. So someone bought in 06 for $400.
Right.
2009, the market falls out and it's down to $300,000. They decide to move on to the next house, but retain this house and turn it into a rental.
Right, save their credit.
Exactly. So now that house is maybe up to worth $375,000. So a concern that I have for my clients is that if they now finally sell this rental property, will they have a taxable event because the property is appreciated now $75,000?
Sure, it's a great question. And what you have is, what happened is when they converted it to a rental is the regs say that you have to use the basis as of the fair market value at the time it was placed as a rental if it was lower than the original basis. And so what happens as time has gone on, the property's increased in value, is now people are wondering, well, if this was my basis that I'm using for tax purposes, do I have the gain? And the answer is no. Because what happens is you still use your original basis for determining the gain, but you subtract out any depreciation that you may have taken. So in most cases, this particular person will have no taxable consequence related to it. So that's great news for them.
Great, awesome. Okay, good. Second question is, the person who probably is renting this $400,000 house is not making money every month, but probably losing money.
You got it.
And I get calls from clients like, hey, I'm losing money, but I can't write it off. Are there any tax advantages now to maybe selling this house? So it's good that there's no tax consequence, but are there even advantages to selling the house?
Well, this is actually where it's an even better time to look about liquidating the home, because those losses that they had claimed in prior years are called passive activity losses. So if they made more than $150,000, this number is just kind of accumulating each year going forward. So when they sell that property, those losses are freed up and can offset their other income, their W-2 income, anything else on their tax return. So it could actually be they get rid of the property, no longer have that negative cash flow per month, no longer have to worry about being landlords, and they actually receive a tax benefit from that time period where it was a rental.
All right, that sounds good. So if you're out there and you're enjoying being a landlord and you want to hold on to your property, please do so. But if you've only done so for the sake of the market to recover, you've had the market recover, there's not going to be a taxable gain from the profit while it's recovered, and there might even be some benefits of recapturing some losses that you haven't had in prior years. So definitely check with your tax advisor or give us a call. We'll make sure we leave Sean's contact information too at the end of this video so you can reach out to him. He's a great resource. He's actually our personal and corporate CPA, so I've definitely put a stamp of approval on you.
Thank you.
And
stamp on the head.
And there's a lot of tax news as it pertains to real estate as of late. In fact, last couple of days, the California Station of Realtors has announced some good news. So, and Lisa's here to share that. So, Lisa, you want to come say hey and
hi guys.
Share the
Hi
news.
everybody. Thank you for joining us today. There has been some really good news coming out on the short sale front. If you sold your house as a short sale in the past, or you're looking at selling your house and taking a short sale in the future, you may want to know about this information, and we're going to post it all on our website. But there was confusion and some changes where if you sold your house, say for $300,000 and you owed the bank $400,000, that $100,000 discrepancy was possibly taxable. That is not the case. They came out and said, no, it's not taxable. So if you did pay taxes on that phantom income in the past, or it was stopping you from looking at short selling your home in the future, hey, there's been some changes. So go to our website, take a look at the documents we have there. Also call your tax person and get some advice on what you can do. So that's about it I was going to share.
All right.
Yeah.
That's all we got then. Get out there and enjoy your holidays, and we'll see you next time.
Yep. Happy holidays, guys. Thanks. Bye-bye.